Moving now to long-lived assets. The first and most important point related to long-lived assets is whether to capitalize or expense. And you need to know this table very well. If you are comparing two companies that are similar in all respects, one capitalizes, which means that it buys the asset and then shows it as an asset, versus another company that buys the asset but then expenses it. What is the difference in total assets? Obviously, the company that is capitalizing will have higher total assets. If the assets are higher, then equity will be higher, because capitalizing versus expensing makes no difference to liabilities. Income variability will be lower, because every time you buy an asset, you then capitalize and then depreciate over a given period of time. The net income in the first year will be high, because compared to the expensing firm, you are realizing less cost. You only have the depreciation cost. But in later years, the income will be lower, because with the capitalizing firm, you will have depreciation in subsequent years. CFO is going to be higher. Why? Because that particular expenditure will be shown as a CFI. It will be impacting the cash flow from investment. For an expensing firm, it will be shown as a CFO. And then for the same reason, CFI is lower for the capitalizing firm. The debt to equity ratio is lower. The interest coverage ratio in the first year is higher, and coverage ratio later is lower. So let's just understand the interest coverage ratio in the first year. Interest coverage ratio is EBIT over interest. So a firm that capitalizes, its EBIT will be higher in the first year, because compared to the expensing firm, or with the expensing firm, that entire cost is actually reducing EBIT. So that's why the expensing firm will have a lower EBIT and the capitalizing firm will have a higher EBIT in the first year. Accounting for long-lived assets. Upon acquisition, long-term tangible assets such as property, plant and equipment are recorded on the balance sheet at cost, which is typically the same as fair value. The assets costs might include expenditures in addition to purchase price. For example, the cost to put the asset in place and get it functional is also capitalized. So those costs should be capitalized. The costs required to make the asset perform the function that it is being purchased for. Under IFRS, research costs are expensed. So this is where you are maybe developing intangible assets. So you are developing a patent, for example, then, or this actually applies to any asset. As long as you're doing research, then IFRS says that the costs are expensed as incurred. But then once you enter development phase, so the concept is proven and you are developing, then IFRS says that you should capitalize. US GAAP requires both research and development costs to be expensed. So in this context, the US GAAP takes a more conservative view. Costs incurred to develop software for sale to others are expensed as incurred until the product's technological feasibility has been established. Once the feasibility is established, then the subsequent costs should be capitalized. In terms of costs incurred to develop software for internal use, IFRS says that these should be capitalized once feasibility is established. US GAAP says that capitalize all development costs. Now this is slightly tricky, because earlier US GAAP was more conservative. In the case where we develop software for internal use, then here US GAAP just says capitalize. Capitalization of interest costs. For constructed assets, interest costs during construction are capitalized as part of the asset cost. Use rate on borrowing related to construction. If no construction debt is outstanding, If no construction debt is outstanding, then interest rate is based on existing unrelated debt. An important point here is that the interest paid during construction is capitalized. If you pay interest after that, that's not capitalized. It's only during construction. So if construction is over 2 years, it's over those 2 years the interest that you pay can be or should be capitalized. The capitalized interest is not reported as an interest expense on the income statement because it is showing up as a value of the asset. IFRS says that interest on short-term lending offsets capital costs. So what does this mean? That you borrow 2 million and use that 2 million for construction. Obviously you are paying interest on the 2 million, but if that 2 million is sitting in your current account and you do get some interest, then according to IFRS, the interest that you get can offset the payments that you make. US GAAP does not allow that. What is the impact of capitalized interest? It causes higher net income and greater coverage ratio during the period of capitalization. So during this capitalization, since we are capitalizing the interest, then we will have, if we have EBIT over the interest expense, if we are capitalizing the interest expense, then the interest expense will be lower and the overall ratio will be higher. So that looks better, but in subsequent years we'll go the other way. So in subsequent years, higher asset values and depreciation lead to lower net income. The point being that because the asset was capitalized, because the interest was capitalized, asset values will be higher, which means the depreciation numbers will be higher, which means that EBIT, which does include depreciation, is going to be lower in subsequent years.
A quick word on intangible assets. Intangible assets lack physical structure. Examples include software, customer lists, patents, copyrights, and trademarks. Accounting for an intangible asset depends on how it is acquired. One situation is where an intangible asset is acquired in a business combination. This is where a company buys another company, and as part of that purchase, intangible assets also come over. Another scenario is where a company explicitly buys an intangible asset such as a patent or a copyright. In these situations, the purchase is recorded at fair value. The other scenario is where the intangible asset is developed internally. Under IFRS, the research costs are expensed as incurred and development costs are capitalized. US GAAP requires both research and development costs to be expensed. The situation is a little different for software, and even with software there are two categories: software developed for sale to others and software developed for internal use. With software developed for sale to others, the costs are expensed as incurred until the product's technological feasibility has been established. Subsequent costs are then capitalized. When software is developed for internal use, IFRS says that the cost incurred should be capitalized only after the feasibility is established. Before that, the cost has to be expensed. US GAAP says that we should capitalize all development costs.
Depreciation and amortization of long-lived assets. Under the cost model of reporting long-lived assets, the capitalized cost of a tangible long-lived asset is expensed through a process called depreciation or amortization. An asset's carrying amount is the amount at which the asset is reported on the balance sheet. Carrying amount is also called net book value. So carrying amount is historical cost minus accumulated depreciation. There are several depreciation methods. The major categories are shown here. Straight line, which means you depreciate the same amount every year. Accelerated methods, where you depreciate more in the early years, less in the later years. Units of production methods, where you depreciate based on how much the machine was used. IFRS requires company to use the component method of depreciation, which means that if you have a machine with two major components, one component has a 5-year life, the other has a 3-year life, then IFRS says that you depreciate the 3-year component for 3 years and the 5-year component for 5 years. US GAAP allows component depreciation, but the method is seldom used in practice. So the distinction is that IFRS says required, US GAAP says optional. You need to evaluate and interpret the impact of a company using straight line depreciation versus accelerated depreciation. DDB stands for double declining balance, which is just one sort of accelerated depreciation. This table needs to be understood and mastered. Obviously, a company using straight line depreciation will have lower depreciation expense in the early years. The accelerated depreciation company will have a higher depreciation. The rest of these items are evident as long as you understand the first one. So if you are watching this video, make sure you pause it and understand the rest of the items. Then we come to the revaluation model. The revaluation model is an alternative to the cost model for the periodic valuation and reporting of long-lived assets. IFRS permit the use of either the revaluation model or cost model. US GAAP does not allow revaluation. So here's another difference. Revaluation changes the carrying amounts of classes of long-lived assets to fair value. So if a particular class of assets is being valued based on the revaluation model, then essentially we mark to market. So we reset the value on the balance sheet based on current fair value. Carrying amounts are the fair value at the date of revaluation, less any subsequent accumulated depreciation or amortization. So this doesn't happen every day. It might happen, say, every year. So end of a year, you might revalue, or it might happen every 3 years. So you might revalue after 3 years, and then the subsequent depreciation happens based on the revalued amount. Impairment and derecognition. Under IFRS, the impairment loss is the carrying value minus recoverable amount. So just understand the concept. Say the carrying value of an asset is 100, and because of some fire damage, the recoverable amount is now 80. So the machine needs to be written down to 80, and 20 is shown as an impairment loss. This recoverable amount is the greater of fair value less cost to sell and value in use. Here we are talking about IFRS. This term, fair value less cost to sell, sounds a lot like net realizable value. Net realizable value, however, is used for inventory. It's not used for long-term assets. But the concept is similar. Fair value less cost to sell. The other item here is value in use, which is the present value of cash flows from that asset. So if the asset will generate cash flow and the present value of that cash flow is 75, but the fair value less cost to sell is 70, then what's the recoverable amount? It is the greater of the two, which is 75. Under US GAAP, we first do the recoverability test to determine whether the asset is impaired. An asset is impaired if the carrying value is greater than the asset's future undiscounted cash flow. So this is simply a litmus test. If the undiscounted future cash flow is 90 and the value on the balance sheet is 88, then you do not impair. So you just make a comparison and stop. On the other hand, if the undiscounted cash flow is less, then you impair. But to compute the impairment loss, you need to find the difference between fair value and carrying amount. Next, derecognizing. A company derecognizes an asset, which means it removes the asset from the financial statement when the asset is disposed or expected to provide no future benefit. A company may dispose of a long-lived operating asset by selling it, exchanging it, or abandoning it. The gain or loss is equal to sales proceeds minus the carrying amount. Investment property. Investment property is defined as a property that is owned for the purpose of earning rentals, capital appreciation, or both. In other words, this is not linked with the cooperation of a business. Under IFRS, companies are allowed to value investment properties using either a cost model or a fair value model. The cost model is identical to the cost model used for property, plant, and equipment, where we start with the historical cost and depreciate. But the fair value model differs from the revaluation model used for property, plant, and equipment. Under the fair value model, all changes in fair value of investment property affect net income. In other words, unlike available for sale securities, where changes hit OCI, here any changes in value, even though they are unrealized, go straight to the income statement. Under US GAAP, investment properties are generally measured using the cost model. In other words, with US GAAP, we don't have a separate category called investment properties, and we don't have a revaluation model there either. So if you have investment property, it is just treated like any other property and treated using the cost model. Next point in this reading has to do with the comparison of operating leases and financial leases. If two companies are similar in all respects, except that company F uses finance leases and company O uses operating leases, then what company F is doing is creating assets and liabilities. So if you recall, if a lease is a financial lease, then you take the present value of future cash flows, and that amount is added to the assets and the liabilities. So that is why, relatively speaking, the assets for company F will be higher and the liabilities for company L will also be higher. At least initially, the equity will not be impacted for either firm. The net income in early years is lower for the firm that does a finance lease because its expenses are higher. Why are expenses higher? Because with a finance lease, there are two kinds of costs. There is an interest cost and there is a depreciation cost. And the interest cost tends to be high initially because the lease payable is high. The other impacts shown here are reasonably self-evident. The one that I keep testing people on is cash flow from operations. So I want you to think about why the finance lease has a higher CFO. So the company that does the finance lease, it has a higher CFO relative to the company that does operating leases. Why? Right, the best way of looking at it is cash flow from, so with cash flow from operations, if you think about an operating lease, the entire amount paid is an expense. It's an operating expense, which brings the CFO down. In terms of the finance lease, we have a depreciation expense and we have an interest expense. But let's say that on the cash flow statement, even if we are treating the interest expense as an operating expense, on the income statement, interest is, for a non-financial company, interest is always non-operating. But on the cash flow statement, under certain circumstances, the interest expense could be an operating expense. But what about depreciation? So it is non-cash, so it doesn't show up. But the big reason is that with the CFO, the entire amount is hitting the CFO part of the cash flow statement. Next point has to do with the ratio impact of lease accounting, and we are still on a lessee perspective. Earlier slide was also a lessee perspective. Lessee is the entity that is using the asset and making the payments. So what you need to be able to do is pause the video or take a moment and fill out this table. Again, imagine that one company is company F that does finance leases, the other company is company O that does operating leases. So what is the impact on these various ratios? This is what you should come up with. And if you understood the discussion from the previous slide, all this should make sense. Again, from a testability perspective, understanding the impact of whether a company does a financial lease or an operating lease is important. When a company has a substantial amount of operating leases, adjusting reported financials to include the impact of capitalizing these leases better reflects the company's solvency position. Later in this class, we are going to look at a mock exam where we convert operating leases into financial leases. Now let's take a quick look at the lessor perspective. This is the entity that is leasing the machine and receiving payments. With an operating lease, the lessor will record revenue when earned, report the leased asset on the balance sheet, and depreciation expense on the income statement. With the finance lease, the lessor will report a lease receivable and then reduce the asset, which is and then reduce the asset by the carrying amount of the asset leased. So the assets on the balance sheet essentially will come down because essentially the asset that is being leased has been sold. It's gone onto the balance sheet of the lessee. Under US GAAP, we can have two kinds of finance leases, a direct finance lease and a sales type lease. With a direct finance lease, the present value of lease payments are equal to the carrying value of the leased asset, and the lessor essentially earns interest revenue. With a sales type lease, the present value of the lease payments exceeds the carrying value of the lease asset, and the lessor earns both interest revenue and a profit or loss from the sale of the leased asset. And generally this will be a profit if the present value is greater than the carrying value.